There is a number that determines more about your life than almost any other. It decides where your kids go to school. It shapes how much money you have left at the end of every month. It determines whether you feel financially stable or permanently on the edge. That number is the price of a home. And in the last 2 decades, that number has done something extraordinary. In most major cities across the United States, the United Kingdom, Canada, and Australia, home prices have risen so far so fast that buying a property on a median income is now mathematically impossible. Not difficult, not a stretch. Impossible. In 1980, the average American home cost roughly 3 times the average annual salary. Today, it costs more than 7. In cities like Los Angeles, Toronto, Sydney, and London, that multiplier is closer to 12 or 15. And here is the part that should make you stop. Almost none of this happened by accident. The story we were sold. For years, the explanation was simple: supply and demand. More people want homes than there are homes available. It is just economics. Nothing to see here. And there is some truth in that. Population grows. Urbanization concentrates millions into relatively small geographies. Construction has not always kept pace. But supply and demand alone does not explain what has happened. Because if this were purely a supply problem, prices would have risen steadily. Instead, they spiked, they accelerated, they started behaving less like a housing market and more like a financial asset. Volatile, reflexive, detached from the actual cost of building a structure on a piece of land, which means something else is happening. To understand what, you have to go back to a decision made decades ago. A quiet policy shift that most people never noticed, but which changed the economic rules for millions when homes became investments. For most of modern history, a home was a place to live. Its value mattered, but it was not the point. The point was shelter, community, stability. Then, in the latter half of the 20th century, governments across the Western world began doing something subtle but consequential. They started building policy frameworks that actively encouraged home ownership, not just as a social good, but as a wealth-building vehicle. In the United States, the mortgage interest deduction allowed homeowners to write off the interest on their loans. Capital gains exemptions meant you could sell your home at a massive profit and pay little to no tax on the windfall. Local zoning rules, typically controlled by existing homeowners, made it increasingly difficult to build new housing, keeping supply constrained and values protected. In the United Kingdom, the Right to Buy scheme in the 1980s sold millions of social housing units to residents at steep discounts. The intent was admirable. The consequence was a permanent shrinkage of the affordable housing stock that has never been adequately replaced. These were not accidents. They were decisions. And each one sent the same signal to the market. Housing prices will be protected. Prices going up is the goal. When you build an economy in which a large portion of middle-class wealth is tied to home values, rising prices stop being a problem. They become a political necessity. The money that changed everything. Now add the financial layer. In the aftermath of the 2008 financial crisis, central banks around the world did something unprecedented. They slashed interest rates to near zero and kept them there for more than a decade. The logic was sound. Cheap money stimulates borrowing. Borrowing drives investment. Investment creates jobs. It works, at least in the short term. But cheap money also flows into assets. And in a world where interest rates are near zero, bonds yield almost nothing. Cash savings erode and stocks feel volatile. Real estate becomes something close to irresistible. Capital flooded in, not just from individual home buyers, but from institutional investors, hedge funds, private equity firms, pension funds, and real estate investment trusts, all searching for yield in a low-rate world. In the years following 2010, large institutional investors began purchasing entire neighborhoods of single-family homes at scale. One firm alone, Invitation Homes, backed by Blackstone, acquired over 80,000 homes across the United States, not to live in, to rent. Competitors followed. Entire categories of homes that had previously been entry-level purchases for first-time buyers were absorbed into institutional portfolios. converted to rentals, and held for appreciation. The math here is important. When an institutional investor buys a house, they are not competing with you on the basis of need. They are competing on the basis of yield. They can pay more than any family can justify because they are not thinking about monthly mortgage payments against a salary. They are thinking about portfolio returns against a cost of capital. And they have been winning. The zoning wall. On the supply side, the story is just as deliberate. Zoning laws govern what can be built, where, and at what density. In most American cities, somewhere between 70 and 90% of residential land is zoned exclusively for single-family homes. One house per lot. No apartments, no duplexes, no mixed-use buildings. This is not a natural feature of cities. It is a policy choice, one that was often explicitly designed to preserve property values and, in many historical cases, to maintain racial and economic segregation. The zoning map of almost every major American city is partly a legacy document of exclusion. The consequence today is that even in places where demand is intense, where people desperately want to live, the legal framework makes it nearly impossible to build enough housing to meet that demand. Adding a 4-story apartment building in a desirable urban neighborhood can take years of hearings, environmental reviews, legal challenges, and political negotiations. And at each step, the people with the greatest incentive to block it, existing homeowners, have the loudest voice. This dynamic has a name. Economists call it NIMBY. Not in my backyard. But that phrase softens what is actually happening. What is actually happening is that one generation of property owners has effectively used political power to restrict housing supply for everyone who came after them. And it has worked. Construction of new housing per capita in the United States today is roughly half what it was in the 1970s, in a country whose population is significantly larger. Who pays? The costs of this system are not evenly distributed. If you bought a home in a major city before 2000, you have likely experienced a generational wealth transfer in your favor. Your net worth has climbed not because of anything you did, but because the market, shaped by policy, rose around you. If you are trying to enter the market today, the calculus looks entirely different. The median American home now requires a down payment of roughly $60,000 to $80,000 just to get in the door, before the mortgage, before the property taxes, before maintenance. For a household earning a median income and carrying student debt, that number is not a stretch goal. It is a decade of savings. The generational math is brutal. The homeownership rate for Americans under 35 has fallen steadily for 20 years. Young people are not failing to buy homes because they spend too much on coffee. They are failing because median wages have not risen proportionately to housing costs, and because every policy lever, from tax incentives to zoning rules to institutional investment frameworks, has been pulled in favor of asset appreciation over affordability. Renters pay the price most immediately. When home ownership becomes unaffordable, demand for rental housing surges. Landlords, including institutional ones, respond by raising rents. And since many of those institutional landlords have pricing software that shares data across markets, rents in entire cities can move in coordinated ways that would have looked suspicious under older market structures. An investigation by ProPublica found that RealPage, a major property management software company, used an algorithm to set rents across millions of units simultaneously, essentially allowing competing landlords to price as a coordinated group. The Department of Justice has since opened an antitrust investigation. The housing market, it turns out, is not always the free market it claims to be. The political problem. Here is why this is so difficult to fix. In most democracies, homeowners vote at significantly higher rates than renters. They are older, wealthier, more established, and more politically organized. Their interests, primarily the protection and appreciation of their largest asset, are efficiently represented in local government. Any politician who seriously proposes reforming zoning, taxing land value, or restricting institutional investment in housing faces an immediate and organized opposition from constituents who have the most to lose from change and the most energy to fight it. The result is policy paralysis at exactly the moment when policy action is most needed. Governments announce housing initiatives. They fund task forces. They set construction targets. And year after year, those targets are missed because the political will required to override entrenched homeowner interests does not survive contact with election cycles. Some places are experimenting with reform. Minneapolis eliminated single-family zoning citywide. New Zealand passed legislation requiring cities to allow higher density near transit. Oregon changed state zoning law to allow duplexes on any residential lot. These are meaningful moves, but they are the exception, and even where policy changes, construction pipelines take years to deliver meaningful new supply. The gap between the housing we need and the housing that exists is not something that resolves quickly, even under ideal circumstances. The bigger picture. There is something deeper at stake here than real estate. When housing becomes an investment vehicle rather than a place to live, it fundamentally reshapes how people relate to each other and to their cities. Neighborhoods stop being communities and start being portfolios. The incentive to welcome newcomers inverts into an incentive to exclude them. Civic life hollows out as people spend more of their income on housing costs and have less left over for everything else. There is also an economic cost that rarely appears in housing market statistics. When workers cannot afford to live near the jobs that need them, labor markets misallocate. Productivity suffers. Innovation concentrates in fewer and fewer places because the cost of being in those places screens out everyone except the already wealthy. Stanford economists have estimated that restrictive zoning in American cities costs the country somewhere between $1 and $2 trillion in foregone GDP annually, because workers who would be more productive in high-density urban economies cannot afford to live there. That is not a minor rounding error. That is an enormous, ongoing, self-inflicted wound, sustained by policy choices that benefit a minority of existing property owners at the expense of the broader economy. What does this mean for you? None of this means you should not buy a home if you can. For most people, home ownership still builds equity over time, provides stability, and offers real value. The problem is not owning a home. The problem is a system that has made that decision unavailable to a growing share of the population. What it does mean is that you should be skeptical of narratives that frame housing unaffordability as simply a supply problem, or a generational failing, or an inevitable market outcome. The housing market has been shaped by zoning laws written by homeowners, tax policy designed to reward ownership, interest rate regimes that drove institutional capital into residential real estate, and regulatory frameworks that allowed algorithmic coordination between landlords. These were choices, and choices can be made differently. The question worth sitting with is not just how we got here. It is who benefited from each of these decisions, and whether the political will to change them will ever outweigh the financial incentive to maintain them. Because right now, for millions of people, the answer to the question of where they will live, how much they will pay, and what financial future they can realistically imagine is being decided not by markets, not by economics, and not by anything resembling a level playing field. It is being decided by policy, and policy, at least in theory, can change. The harder question is, change for whom?